Just a disclaimer, I don't know what I did to warrant a two-line introduction. My career is not half as illustrious as the esteemed panel sitting before us. In fact, in the next 20 minutes or so, I'm looking forward to learning a thing or two from everyone. So I'm treating this as a learning opportunity. Consider this a goof up from the organizers. That said, since morning, I hear we've had engaging sessions about the multiple facets of a CFO and the multiple KPIs that the CFO is managing in an organization today. We've chosen a very specific domain to double click, right? And we're talking about transformation in supply chain finance. Why have we chosen this topic at all, right? What is the significance in the long list of KPIs that the CFO needs to manage? What is really the significance of supply chain finance? Well, I personally, being a supply chain finance professional, I see it this way, right? That this is the short way of fulfilling the credit gap in the MSME industry in India. And all these gentlemen here, they're dedicating some time from their busy calendars to act towards this cause. So with that larger focus, I would like to kick off the discussion with my panelists. Gentlemen, supply chain finance is a very old product, right? It's a 15, 20-year-old product. Why then in the last 5, 6 years we see or we realize that this is becoming the hotbed for innovation and growth? What has changed in this industry over the last 15, 20 years, and since you guys have spent multi-decade careers? If you can help us understand, what does supply chain finance mean for your specific organization, and how has it changed over a course of time? If you are okay, I would like to kickstart with Gautam. Gautam, you've taken the center seat. Why don't you first explain the relevance in your industry, and then how has it changed for you over the years?
Yeah, thank you. Good afternoon, everyone. So, I think it's a very relevant question, and we all in the finance profession will definitely understand the importance of having supply chain finance in place. So, if I break up into this supply chain finance into two parts, one is part of vendor financing, and another one is channel financing. So, I'll talk about channel financing more for now. So, I think we all have understood we've gone through so many ups and downs in the economic situation across the globe and even in India as well. Recently, the COVID one, we all know. Fortunately, COVID was not so critical in terms of when it comes to the industry where we belongs to. There was so much demand suddenly came up during the lockdown phase, and people were, most of them were like in home, so the demand of products and these things came up. However, this also led to a more requirement of working capital also in the industry. And fortunately, we were having a supply chain channel finance program in place. So most of our channel partners took advantage of the situation, and in a positive sense, of course. And they could cater to the demands in the market. And it also gave a lot of comfort to the organization in terms of managing the working capital and even the DSOs, we call it, for the cash flows. And this really helped. So if we talk about the consumer FMEG, fast-moving electrical consumer goods, so where the channel partners' volume are very, very high. It's more of a distribution kind of network. So we have almost 3,000, 4,000, 5,000 channel partner. And if we keep on extending open credit to them, then definitely you can imagine the requirement of working capital at our end. So while having banking finance or NBFC step into the supply chain finance, and they could provide a lot of comfort to both the ends to optimize the resources and the opportunities. Yeah.
And just a double click on, since you've spent about 20 years in the same industry, right? Have you seen a change from what it was about 10 years back to what it has transpired post-COVID?
Absolutely. I think there's a huge change in the way channel financing or the open credit were working. And now, in recent time, especially for last 3-4 years, the change has been completely phenomenal. I think the credit, most of the credit goes to the technology companies and digitization in place. So we can see the era of having manual credit approvals and sanctioning, disbursement. So all these processes were completely manual. Now having technology in place, I mean, it's just a click of button. I mean, if you just give a PAN number and you'll get the entire credit history of our channel partner or the promoters of the stakeholder in the supply chain, and you can get disbursement, everything. I mean, just a click of matter. So I think the technology has played a big role in this transformation. And of course, the equipped by our channel partners as well. So this is two-way communication. But yeah, by and large, the improvement or transformation has happened due to technology.
Makes sense. And on the same note, Venu, I'd like you to join in because you have one similarity with Gautam, right, of spending a long career in one industry. But for you, supply chain finance means actually the opposite side, right, because you represent auto industry. Why don't you talk about that?
Happy to see very good story which Gautam told. Ours is not like that. We are from automotive industry. 70% of my revenue goes to raw material and bought out parts. So you can imagine you have to play around with the 30%. And we deal with steel industries. We deal with the partners, whoever is there, who deal with again with the steel. So you can definitely, all the audience must be knowing what sort of things are going in the steel industry. So prices goes up, prices comes down. Only solace here is OEM compensates, but there is always a period where you are likely to have a lot of difficulty till the time you get a compensation. So you have to have a cash reserve in your hand. No steel company never ever give any credit. They must be giving in the past, but right now nobody is giving. So all on pro forma invoice based when they go. So supply chain finance play a vital role wherever some are offering 30 days, some are offering 60 days credit period, maximum 90 days. That again depends on your company rating, right? So for us, it's a roller coaster ride every time. Then whenever raw material goes up, then it is a very difficult subject. Last financial year, you can see 17 rupees per kg raw material has gone down. And prior to that year, it has gone up by 20 rupees. So it's a mixed things, and we try to save every pie. We try to find a lot of opportunities. So what we did is a roller coaster ride, which is there for automotive industry. We converted that to opportunities. So what we can save. So we started buying bulk coils, then cutting into cut to size for the purposes. So in this aspect, you can see supply chain finance play a major role for us because the majority of the money going out is through that. Then to vendors also we extended so that we will be able to have a better partnership with our vendors. They also do need. And it is again linked with the discounting finance. So unless other way you are a great cash rich company, which is never ever be there with any company because every company wanted to do expansion, right? So the cash reserve, whichever is there, always goes to the expansion. So here, then we get a discounted price revenue every time when invoice discounting and other things from the OEMs. So here, it's a bigger challenge for us that the money which comes in as a revenue is also comes at cost. The money which goes out also at some cost. So very thin margins people are to
So
work
then
on.
as a CFO, you dedicate a lot of time to this subject.
Yeah. That's what I said, the roller coaster, right? And so how we are going to make it smooth. So it's a daily affair, right? So
Yeah, and
you have to do
well,
micro cash management is the one. That's why I was just speaking to a couple of people. Here, every automation which is going to be there will be useful for us. So which we are now practicing from all sides. You call it GST reconciliation, getting ITC full-fledged, then any nook and corner, here low-hanging fruit cost reductions. So everything is going to play a vital role to save ourselves so that we pay back and get the things. And another bigger challenge these days it is going to be every OEM, particularly MNCs which are there, made us so competitive. They want us to keep 2 days finished goods at company, 1 day finished goods at their end. They sign up with you that 15 days raw material you have to keep at your end. So all these are the tagging and other thing, right? The QR code base. So they track us. So somebody is outside, like, the detective side of it. They are auditor, they're everything. So supply chain finance is the one. That's why it's very close to my heart and it's a great subject to discuss, go on discussing. I think audience will get bored, but it's a very, very interesting subject for a company like us, Auto Ancillary, and any automotive industry like that, because where steel consumption is more, where steel is the one which is really ruling the world.
And well, yes, as industry people, automotive and auto ancillaries is the single largest contributor to any supply chain finance programs or economy as well. So I completely understand. And we'll talk about some of the innovations you were alluding to. But before we get there, I would just like to quickly bring in a couple of other panelists. Deepak, wanted to understand from you, although there are a lot of changes which are happening, double clicking of transformation and digitization which is happening in supply chain, still, what in today's day and age are the challenges that you are facing with your existing programs?
Yeah. So, Mansha, I think this supply chain financing was not part of the mainstream working capital finance earlier, but I think this was accelerated post-COVID, or I would say like in last 3-4 years. And initially there was some teething issue in terms of onboarding the vendors, and then there is no alignment with the vendors. Then some of the supply chain financing companies, they are putting a standard limit to a vendor, right? And then the limit goes up, then there are certain issues, right, in terms of. But I think now there are a lot of improvement in terms of onboarding process, and like now it's like just single a click of button, you can get all these details. You need to just provide certain information, and then everything is very smooth. The second part, or the second issue I would say, is that sometimes there is some security or some integration issue with the ERP, because when you have a lot of vendors on your side and then you don't have a proper integration with the vendor financing, then it creates a lot of hustles and the frictions in your operational side. So I think if these are the two issues, and then the third would be the security issue, because nowadays everything is available, right? So if these are the three main issues, if someone can handle, then I think this is going to be a very good strategy for.
So we spoke about security, we spoke about vetting invoices at source, which is the ERP. Which was the third one?
The third was the integration with the existing ERP system. Otherwise, if you don't have an integration, then this will create a lot of hustles in your operational part.
Got it. And Shesh, if you'd like to come in and maybe add your challenges that you faced in your organization, specifically from an FMCG background. And if you could, to those challenges, also add what could be the focus areas for banks and fintechs to solve these challenges, right? So if you've been able to identify any focus areas to send out to industry people, please.
Thanks, Mansha, for the question. A bit of context, 20 years in FMCG, and currently I work with General Mills. I'm not sure if many of you know about General Mills. It's a US-based food MNC. Pillsbury is the flagship brand, right? So that's the context. See, broadly, Mansha, I see there are three issues which act as barriers, right? And let me give you an example of General Mills or any food FMCG. A majority of our purchases or raw materials, they are from unorganized sector. So we purchase more than 150,000 tons of wheat, right? Now we do purchase it from intermediaries or dealers who in turn purchase from farmers. So whenever we have tried to evaluate, and the other important raw material is say sugar, very similar supply chain. So whenever we try to evaluate a platform, we find that they are not able to cater to this set of unorganized vendors. Neither the vendors are looking, the days of credit is extremely low. It can be one day. because the way it works is they pay in cash. So they would purchase stock in cash, and they would expect credit. It can be from 1 to 15 days, depending upon the company, etc. So in this, whatever we have found, the platforms, generally this sort of unorganized vendors, they remain outside the scope. There are platforms like Threads, etc., but then the onus is also on the vendor to make use of it. Here, that itself is missing from their end, because they are very transactional about the entire thing, and hence, and it's very cyclical as well, because all the purchases of wheat pretty much happens in 3 months' time. So that's the first thing, because if you move out 40-50% of your vendors, then it starts, as a platform, it starts to become unattractive or too much efforts for a small benefit.
Impact is not seen.
Impact is not seen, right? That's one. The second piece is MNCs. We have a lot of vendors who are based out of India. So when I'm importing cocoa or palm oil and others, again, it's a very, there is no solution which is seamless for vendors who are based out of India. And these are all global vendors. So General Mills operates in more than 130 markets, right? We do have supply chain financing in many markets like Mexico, etc., where it works very well. But in India, I think the platform is not such that it can cater to, it's too complex, is what we see.
Yeah, just to come in from the industry perspective, right? You're right. Until a couple of years back, these were big challenges. And I swore not to sell, not to use this platform to sell. But we should spend some time, because what we've done is we've really taken advantage of some of the initiatives taken by government and RBI recently. So most of us here, I'm sure, are transacting on Threads platform for MSMEs. So the first point that you mentioned about traders or unorganized sector traders, they can very well be covered in the scope. And what fintechs like us, we've done is we've become a middle layer where we can do away with the challenges of onboarding by these people as well. And we will not put the onus of the transaction on these guys, right? And so there are solutions which are available, you're right, but they are more recent. They're picking up. Threads, for example, has seen stellar performance, right? Last year, their throughput was more than 45,000 crores only on vendor payments. On imports, the second area that you mentioned as well, and Amit, please feel free to come in if you have a POV from an industry perspective. ITFS has just launched. It's too early days to comment. Let's see where the journey goes. But you're right, there's still unaddressed areas which also make this area so much more lucrative for financial services players, right? On this note, let's look at some of the innovations that have taken place, right, in the last 3, 4, 5 years, which have made this space so attractive. Gautam, would you like to talk about some of the technology-led interventions, or how has digitized helped change this space for you and create a larger impact in your organization?
Yeah, so I think this is also another important topic, how digitization is basically helping, digitization or rather not automation as such, but I would say digitization. So one example I would like to share here is that, 5 years down the line, 5 years back, we were, making the transactions so manual, right from, channel partner making payment, giving the reference invoice, payment reference number to the organization. They, check the bank account, whether it is credited or not, and then they book the transaction, knock off the invoice, and then finally credit gets released for the further billing. So the entire process was so long and manual. Now with the help of technology, we can seamlessly integrate all these processes, right from channel partner. For example, if we raise an invoice to any channel partner who is there on the supply chain finance program, And the moment we generate invoice, the collection gets triggered automatically. Funds get transferred from the channel finance program to the organization. Organization recognize this payment has came from which channel partner and against which invoice. It gets knocked off. Credit gets released automatically. So almost 90% or 95% of cases, we don't really have to bother into even the transaction level. It just the sales team or the finance team has to focus on their core job, not the clerical job. So this is how the technology is helping business to improve the productivity and make a focus on the core subject rather than this transaction level.
Yeah, makes sense. I've witnessed that change myself. Amit, would you like to come in and talk about some of the transformation, technology-led transformations in this space?
So in the financing side, the technology related changes are immense actually. So you today, if you're moving to the market, previously you were taking a wallet along with you. There is no requirement of taking today wallet with you. Your mobile is having everything, so you can make payments. So the technology in the financing sector has changed everything actually. Previously, the credit appraisal were there. Today, it is well automated because the data is captured in the CIBIL. Even the people previously looking for the personal loans kind of thing went for their personal requirements. Today, many people or everyone is having the credit cards and you have the facilities limit sets against your CIBIL record. So those kinds of financing facilities are available just because of the technology enablers are there, because the data are available with the financiers. So because of all these digitalizations, the financing activity is happening so fast. We were looking like previously people were investing mostly in the property side. Today it is shifting from the property to the mutual fund to the stock direct stock investment. The next era is the financing against the mutual fund. The LAS is very common, but even from the LAS, because the asset, the people have invested most of their investment in mutual fund, the LAS is happening so fast. And because of the digitalization, it is 5 minutes or 10 minutes. Like we are also offering the mutual fund financing. So what we are targeting is 10 minutes or 30 minutes financing. So within 30 minutes, because of the technology, we can finance against the mutual fund or the loan against shares. Or there are other technical items is margin trade finance that we finance from the GM Financial Services. And when you look from the profitability side also, the technology has changed a lot. Like previously, there were customer care departments answering your queries. Today, you call anybody. So everybody has their own Alexa. Whichever place you go, like it's a banking, you go, or you airline, you go, whatever you call, they all have their own Alexa. And then previously it was what we could say, one dial code, two dial code. Right now, it's not even that also. You just request what is your query. They will read your language and they will give you the right appropriate options. So the technology is changing everything from the financing side, from the customer servicing side. The artificial intelligence is there. So artificial intelligence is addressing the fraud. If any unusual transactions happening in your financing side, so if I'm talking from the banking side or the NBFC side, if any unusual transactions are happening, those transactions are getting captured by the artificial intelligence. They are reading so many transactions, giving us the reports. So the management can react. So there is a recent example, UCO Bank, like they received money, but they have not received money, but they have paid to they have credited. So those kinds of transitions are happening, and because of the digitalizations, we are able to capture. Otherwise, we would have known only after 3-6 months that this has happened. But in 1 or 2 days, we are understanding things because the digitalization is there, and it's very important. Digitalization is very important, playing a role in the financing side. And with the volume that we are operating, it is must actually.
No, very well said, Amit. And you gave some retail examples on the mutual fund side. I mean, to me, on the MSME side, supply chain financing is the personal loans equivalent to retail, right? There is no reason why should it take more than 30 minutes for underwriting, or why can the underwriting not happen real time? Because it's essentially a transaction linked financing. And as Deepak said, since the data comes from an ERP, why shouldn't it be real time? So very, very fair points
So I would
said.
just like to add now, what happens about the security of, because in mutual fund finance, the security, the asset value is defined. So everybody is aware what is the NAV of this investment. With this MSC financing, the underlying transition, whether this transition is genuine, all the supplies, services been done, those kinds of some questions are unanswered. So it may take some its own time, but it cannot be in 30 minutes because the evaluation is much important, and when we will be able to capture those things technologically, hopefully then in future it will also happen at a faster speed.
Yeah, if there is an underlying security, you are right. But if it's an unsecured funding, which traditionally it is, then it can happen in real time. Venu, I'd quickly like to bring in, so since you've seen supply chain financing for over 20 years, what about organizations starting now? Do you have any piece of advice? What should be their focus? Because I've seen traditional programs also do not reach the optimum level of adoption or utilization, right? So do you have any inputs for organizations which are starting now?
See, any startup, if you see, we end up in seeing they stuck up, they have technology, they have everything. They end up in stuck up at working capital. Same supply chain finance support badly required. Many of the startups which I know, they just got closed because they are not in a position to go for a full scale production after prototyping. So the organization, like whoever is offering supply chain finance, because primarily supply chain finance is unsecured, right? Unsecured only. So whoever has got some collateral or something, or if technological evaluation, if you can do based on the technology, if the supply chain finance side people, if they come forward, start supporting them, it will definitely going to beneficial for the startups and whoever is established companies actually. If they really wanted to grow, because the industry cycle point of view, if you see now next 5 years is going to be the boom cycle, particularly for the automotive industry. If you don't take opportunity right now, this opportunity again somebody else is going to take over, right? So here especially supply chain finance with innovation cycle, like the blockchain, you can call it as, then artificial intelligence, internet of the things, then cloud. Everything has got its own advantage, disadvantages, right? So advantage side, if you see, all are offering a different type of innovative solutions. So just ERP doesn't help us. So we always under the orbit saying that, okay, once we implement ERP, it's going to serve all purposes. But after you implementing ERP also, you end up in doing a lot of manually adding activities. So it's necessary for us to see, definitely differentiate between non-value adding activities and value adding activities. Value adding activity definitely going to give you revenue out of it. Non-value adding activities are quite high. Those are the ones definitely need to be tackled with automation, where you end up in using less people, or that time which is there will be utilized for the value additions. So that's the one which I strongly feel technological edge, which is what we have today, we should utilize and to maximize the efficiency of any industry, because it's applicable for any industry, right? Even production industry, if you see, there also even any bookings and other things you can do on tabs, right?
So basically the advice you're extending is that even if you're a new company, day one have an automated
Yes,
SCF
absolutely.
solution.
Yes.
Will go a long way in managing your working capital. Shesh, would you like to talk about what advice would you like
See,
to give?
first let me give out a secret in terms of how MNCs actually work internally, and then maybe it will lead to an advice even to the organizations, right? See, the MNCs, and I worked in few, right? So they are all metrics structured. You will find that in many MNCs, the major measure of a CFO is actually at a EBIT level, right? So the why needs to be very clear. Working capital is actually not a very important measure for the MNCs because they are cash rich. So one of the problems of MNCs is they are not able to move the funds out of India. They will continue to invest. They generate cash. They will continue to invest. So one advice for all the CFOs is to take a look at it holistically. Because you see, as a CFO, you need to internally sell as well. Generally, you will find that MNCs have their treasury centralized. So you will treasury are either US based, Singapore based. That's how it is. So if you are trying to onboard a financing platform based on working capital, I have never seen it go through because it's.
Then what should be the pitch?
The pitch is profits. The pitch is that it will help you save 2 points, or it will add 2 points of EBIT because you are able to get a better discount because the vendor is getting paid in advance.
Yeah.
That's the pitch.
And MNCs there, they also have the advantage to use their cash surplus.
Yeah.
Since you're cash rich, to deploy
So
those
hence the
funds.
pitch is always on the profit side. And the pitch is in terms of growing business. So if the platform is able to give data analytics, dashboard, insights, see, because it's very interesting set of data which you will get. If you have major part of your vendors on the platform, it's a very rich source of trends, insights, all the vendors being more of a strategic vendor versus a transactional one. That is the pitch for vendors. So the advice is to also understand the ecosystem, both for vendors who have these platforms and for CFOs, and try to sell it internally. Focus on data analytics. So this is something which is extremely important for us, for CFOs. So focus on that. And third is give flexibility to the vendors. We did evaluate, I think, 2 to 3 years back. And now I think things have changed. There are a lot of NBFCs, bankers, fintech. Everyone is giving, is trying to fund the vendors. Earlier it was only banks and it was not very lucrative. Even the vendors were not very excited because they could themselves get better discounts, right? So now, but I think we have moved a long way. So now there are number of participants, but the pitch has to be very different to MNCs and to CFOs.
So you make a very interesting point there, right? You're saying analytics, reporting, dashboarding is very important and the pitch has to change. So in my experience as a salesperson, I get asked this a lot by the CFOs that the margins are so thin. How can I afford another player between a bank and my vendors, right? So, but what you guys are saying is that analytics layer is very important. That layer of automation is very important. As CFOs, sounds like you've participated with some of these players to add this value, and which is why you're able to cite examples. Deepak, so just extrapolating this thought, right? Traditionally, this was only a banking product, and more recently, this has become a fintech product, right? 30% of the fintechs are focusing on supply chain finance on the MSME side today. It has added thousands of crores of valuation. What do you see is the role beyond data analytics, right? Why is it important? Have you witnessed a change or a larger impact by enrolling with this party, or banking is a good enough animal to deal with in your experience?
No, I think, Mansha, both, I think the traditional banking companies and the fintech, both will play a key role in terms of, extending the supply chain financing. If I'll quote one number, because the MSME contributes close to 30% of India's GDP, right? So there's a huge gap in the MSME segment in the working capital side. So I think once you have the technology advancement, second, now you also have a GST, because GST is also playing a very key role, because now the fintechs and the banking partner, they are very comfortable to get the data, right? Earlier, it was a big challenge because they were not comfortable to get the numbers, or they were not able to find, they don't have a complete reliance on the numbers which MSME player is sharing. So now I think everything is in sync, right? So this is going to be a big driving factor for the growth perspective. And I'll just quote one more important point in my previous assignment when I was working with a startup. So in a startup, again, the key, because they have a fundings and everything, right? But again, you need to have a fine balance between when you need to, fund towards your growth, right? And then you can leverage on the supply chain financing from the fintechs or the banking partner, and then you can have a balance between both the aspects. So I think this is very critical from that standpoint.
You see the value in the... So with the bell, I don't want to take away from the audience an opportunity to ask you guys any questions that they might have.
I just want to add here, the technology or the fintech companies are pushing the banking system to move ahead and compete with them in the SME finance sector. But we also thank the regulatory environment and the compliance environment. We also always crib about the compliance. But being Indian, or the government has compelled, or the regulators have compelled everybody, including the enterprises, companies, individuals, SMEs, partnership firms, everybody they have captured, and wherever they found there are leakages, they have covered those leakages. And the scope of defaults are very less. That is the reason the people are ready to invest money in India, and they are feeling that their money, whatever they lend in the market, whether to SME or the other sectors, the money is safe. And that is pushing the technologies, because the growth is there, the opportunities are there, and the technology is coming inside to cater to those growth.
Fair point. Actually, RBI has contributed a lot to this.
They are the actual contributor, actually. Otherwise, nobody would have lended money to you.
Yeah, that's a fair point. To the audience, if you... Yes, please.
Amit, to add to what you say, a lot of this is also enabled by what we call the India stack, which we sometimes, like today, you said people will trust an MSME's invoice. It is because they can go to the GSTIN and download the invoice and cross-verify. Right. So I don't need to depend on the MSME vendor to do it. Having made that remark, the question I have is, both supply chain finance and channel finance is a marketplace. So there are two people with an intermediary in between. In most business models, which are marketplace models, people have to decide what comes first in terms of driving a particular business. The way I see it here, suppose we confine this to supply chain finance, then in what situation should the driving come from the buyer, and in what situation should the driving of this marketplace come from the MSMEs?
Amit? And
So
I'll add my view to Amit.
Yeah, because technically we are not into this business actually.
So let me, if you're okay, let me try and answer that, right? So supply chain traditionally was not a marketplace business. It has started emerging as a marketplace business today. To my mind today, because it's a new market, the lenders are more comfortable with the buyer or the anchor taking the risk, and which is what reflects in the market today. The right solution to this will come with time, and to my mind, I think there should be complete democratization where the channel partner should make this decision. With ample data available now to make these underwriting calls, and lenders having behind them years of experience and algorithms which are trained to take risk on these channel partners, I think the future is democratizing this for the end beneficiary, which is a channel partner and not the anchor. But I'm sure there is some time for this transition to happen.
Check. Okay, thank you so much for an amazing and interactive session.
Thank you,
I
Thank
hope
you
you
so
all
much.
had as much fun as we had putting this together. I certainly learned a thing or two. Thank you guys.
I would CFO Lumina Datamatics to please come on the dais for felicitating our moderator and our panelists.